We're going to do exercise. Just that quick, I forgot what it's called. 412? 412. And then hopefully finish chapter 6. Okay. Hopefully everyone hit. Oh, you know what? I didn't load it into Blackboard. Give me a second here. Hello. Sorry about this, guys. I had all my ducks in a row, but obviously don't. Let's see and make sure I have it in there. Yeah. Okay. Okay. So we're going to do 2 things today. We're going to do the problem 612, exercise 612, I should say. Do one together, and then hopefully finish the handout with the financial statement on the back. So the first thing we're going to do is the exercise 612. And again, you should have gotten that. In your email, I also just loaded it up into Blackboard. And so this is really the problem here. And the first thing to do is to kind of get comfortable with the kind of the new format that it's in. It's not exactly the same as we had before. And so what we have is, here's the inventories that were purchased, the amounts, obviously, cost each. This is all pretty familiar. Ooh, don't want to do that. Now, it comes to the sales. It says that there are 1,500 units of the item in physical inventory on December. So this is the ending inventory. They had 1,500 units. Well, this is the ending inventory. Now, they don't actually tell us how many units were sold. So see if you can figure that out. excuse me. And when you figure it out, either blurt it out or put it into a chat. So these are all the purchases that is available. And they said there's only 1,500 left. They didn't tell us what the sales were, and they didn't tell us the sales price. So we can't figure out the dollar sales that were, but how many units were sold from this? Anyone? Oh, somebody knows it. You guys are toying with me. So how many units were sold? Yep. Put in the wrong spot here. Okay, yeah. So we had available 10,000. And 1,500 of them were not sold. For the ending inventory. To say, yeah, so we had available this many. Not sold, or ending inventory was 1,500. So the sold must be 8,500. Okay, so now here's what we're going to do. This data is the same. This is the same as this. I just got it separated out so we can do it. Just made it, I don't know, a little easier. So we're going to figure out what the cost of goods sold is and what the ending inventory is, doing FIFO, LIFO, and weighted average. Okay. Let me change something here. And I think I'm going to cut it down a little bit. I'm going to make it a little more. Less numbery. Okay, so so one thing we can't do is do the sales. we don't know what these, we know that we sold 8,500 of them, but we don't know what the selling price was. They don't say anything about the selling price, and for what they're asking, we don't need it. Hopefully they sold them for more than they paid for them. Okay. Let me zoom this in a little bit. Okay, so we need to find the cost for 8,500 units, and that is that's that. I do this a little differently, actually. Oops, no. Okay. Kind of go around the horn here. So this is the we define cost for 8,500 units. And so the question is, where do we go to first? So which ones were the first ones in? Should have more room. Yep. Yeah, January 1st. So these are the first ones in. If it'll fit in or not. Let's see. It does fit. Hey, how about that? Yeah, so these are the first ones in. So this is where we're going to start out. So January 1. $2,500. And I think we'll fill in the cost on that right in this line. I think we'll do that later. But we'll get these all figured out before we put it in. Okay, so we found the cost for 2,500. So we still need to find the cost. Now, these 2,500, they're gone. And they're never coming back. So don't try to sell those again. Okay, so this is 8,500 minus 2,500, 6,000. Fire up the old calculator. Yeah. Okay, so we still need to find the cost for 6,000. We've already used the January 1st, so we'll go to February 17th. As a purchase, that's going to be the same thing as inventory. I'll put in purchase, so it looks the same, but this is the same thing as inventory. These purchases are purchases of inventory. Okay, so we purchased 3,300. let's see, 6,000 minus 3,300. 2,700. Okay, now so this 3,300 is gone, never coming back. All right, now here, so here we have the July 21st purchase. Now we need the cost for 2,700. There's 3,000 in here, so we're not going to take all 3,000. We didn't sell all 3,000. We only sold 2,700 of those. So this will look like, let's see, July 21st. And we're only going to take the amount we need, which is 2,700. And so this no longer has 3,000 in it. It has 300. $2,700 was sold. So there's only 300 left in that layer. Okay, I think we'll do the cost of goods sold down here. I think, but we already have these all lined up. We might as well just do it right here. Okay, so this is 2,500 times. My arrow's getting in the way. Rascally arrows. Cost each was $5. Maybe a better way to do this. They already got it numbers for us, so for some of these things. Okay, so and this would be the totals. Okay, so there's the first one. So get the spacing right. The 3,300 were at $6 each. And that was 19. Oops. Yeah. And I'm just getting those from right here. Those first two. Now this one we're going to have to calculate because we didn't take all 3,000. We only took 2,700, so it's not going to be 21,000 per here. we took 2700, so 2700 times 7 . 18,900. I calculate that once again, just to make sure I didn't do it wrong. 2,700 times 7. Yeah. Okay, so this one is a little bit trickier in that it isn't for everything. So all those together will be our cost of goods sold. Plus 51,200. Nope. So that will be our cost of goods sold. Okay, our ending inventory, I'm gonna go ahead and mark these in green. Come on. Come on. There we go. Okay. Okay, so these are the ending inventories. We still have 300 from the 21st. We sold 2,700 of it. There's only 300 left. And at 7 and at 8. Okay, so ending inventory. It is wrong. Hold on, let me get the. Just trying to do the spacing here. Okay, so we still have 300 in that layer at 7. I think that's just 2,100, isn't it? Let me check that one, just make sure. So 300 times 7. Yeah. Okay, so we still have 300 at 7. That's from July 21st. Probably don't need those to be underlined. Oops, hey, I ran out of room. Okay, we still have from November 23rd. Purchase of 1,200 times 8. So that's 9,600. So the ending inventory, this is what was not sold. $11,000. Any question on that thing? There is something I should talk about. Oh, I should have put yes in here. And that is this, the periodic inventory method is used. The periodic inventory method. That's what I showed you, that we've done in class here. So the periodic method means at the end of the period, you calculate the cost of goods sold. There is another method called the perpetual method, and that is after each sale, you calculate the cost of goods sold. Well, first of all, we couldn't do it for that problem because they didn't tell us when the things were sold. But that's one where every time a sale is made, immediately you calculate the cost of goods sold. Doing it by hand is kind of cumbersome to do that. We could do it, but it just takes a lot of time. But anyway, so those are the two methods. The method I showed you was a periodic one. So at the end of the period, it could be the end of the month, end of the year, whatever it is. It's the end of the period, we calculate the cost of goods sold. So the periodic method is what's in the handout, and that is what we're doing for this problem also. There is another method called the perpetual method. And the only difference is the perpetual method, you'll calculate the cost of goods sold for each sale. So if you have 10 sales, you'll calculate the cost of goods sold 10 times. That's the only difference between. Okay, what am I doing here? Okay. So, this one, the periodic thing. Okay. So that is FIFO. And again, we can't do the sales, can't do the gross profit. They didn't give us enough information to do that. Okay. On the next page, again, we're using, this is the same information as this. It's just putting it separately here so that we can, you know, we make our little adjustments to it. Okay. Same as before, though. Let me go one more over. You need to find the cost for 8,500 units. And for this one, we need the last ones in. And which ones are the last ones in? And again, this is that one. The method is kind of theoretical. That the reason we're using the last ones in is because that's the most current price, and that's theoretically the most accurate price for determining the income. It's not the way that things usually are. For instance, you know, if you made a sale in January, it would have been impossible for it to be these ones in November. But the November prices are the more accurate. These January prices are no longer as relevant. Okay, so where do we go to for the Lifo method? Which ones were the last ones in?
November.
Yep. Yeah, so of course, go to start at November. These are the last ones in. So that's where we'll start. $1,200. $7,300. Okay, so this was so that's that one. And these are gone. They're never coming back. Okay, July. $3,000. Those are gone. Those are never coming back. February 17th. Again, these purchases are just the same thing as the inventory, just inventory layers. They purchased inventory. So that layer is. Those are gone. Those are never coming back. We're all the way down to the beginning inventory. Okay. And we only need 1,000. So there's 2,500 in that layer, but we don't need all 2,500. We only need 1,000 of them. Okay. So there's really not 2,500 left here. There's 1,500. 1,000 of those are gone. I'm going to peek up here and see what I did. I'm going to copy that. It does that. It goes all the way off the edge like that. It's weird. Okay, so the purchase we had 1,200 times 8, 9,600. Okay, so now a lot of these, you know, if we do the whole thing, anyway. There we go. You know, they already did the totals for us for these. As long as we sold the whole thing, we can just use the totals they give us. So this would be 21,000. This one, 19,800. Oops, wrong time. This one we have to multiply out. Good news is it's real easy. It's just 5 times 1,000 is 5,000. these lines that are underneath there are confusing. And so all those together will be our cost of goods sold. All right. So 90 plus 85,400. Oops. Now the ending inventory is going to be, oops. Oh. A little bit easier, and that we only have one layer, ending inventory. So ending inventory, we just have the so ending inventory. This is going to look a little bit silly. We have 1,500 at 5 from January 1st. $3,500, I think. You want to check that. So the total is 7,500. A reasonable question is, do we need to put it on 2 separate lines? Probably not. So 1,500 was not sold. That's our ending inventory. These were all sold. And these ones that are sold are, these are gone. They're not coming back. This is actually only 1,000 that were sold in that layer. That 1,000. Okay, so that's last in, first out. Okay. Weighted average. weighted average. Probably going to be much quicker than the other methods. And see if you can figure out the average cost per unit. Yep. Okay. Yeah, so what we're going to do is take our total cost, 62,900. And our available units is nice, well available. Divide those. And it comes out to $6.29. Spacing is weird here. Why is my spacing weird? Huh. I don't know. We're gonna economize space here a little bit so I can fit it on one page. Okay. A nice thing about this one is once you get this number, you know, it's pretty easy. Sold 8,500 units. At $6.29 each. Equals whatever that is. 53,465. So $53,465. That's our cost of goods sold. Ending inventory, in other words, not sold, 1,500 units. $94 9,000. And so you kind of see here, if you look at the average, weighted average one, 53,645, it's kind of in the middle of these other ones here. We kind of summarize it here. So here's our cost of goods sold. Let me go ahead and highlight these. So you can see here's FIFO, here's LIFO for cost of goods sold, and then the average cost. Is kind of right in the middle. Oops. And same thing here for the ending inventories. $11,000 for FIFO, 7,000-ish for LIFO, and then average cost kind of right in the middle of those two, which is what you kind of expect. And notice that the FIFO will usually have the lower cost of goods sold, higher income, and higher ending inventory. And it's the opposite for LIFO. All right, any question on that? Okay. Let's go to our handout. The not this one, the other, this thing. Okay, so chapter 6 handout. 100% sure my page numbers are right here. At page 11. Kind of get this thing spread out for some reason. Okay. Multi-step income statement. We remember it by Scoot. So this is the order of our new income statement. And new income statement. So this is what they call a multi-step income statement. It's similar to our classified balance sheet, and that we put things that are similar, we group them together, just like Cheerios, are in the cereal aisle at the store, grocery store. All the cereals are together. We all know that. So we do the same thing for our income statement. We put those things that are similar together, and that's all we're doing. So the income statement is still the same. It still is, revenues or sales come in, costs or expenses go out. That's exactly the same. What comes in, what goes out. It's just that now we kind of break it up into different categories. And the idea is that these different categories give us a little bit more information than we would have normally. So let me see here. Let's go back to this. Oh, wait, no, I want to share my screen. Okay. So the way we remember it is Scoot, and I can say sales over revenue. So this is the Scoot. If I put I at the end, it'd be Scooty for income. Yeah. That one doesn't fit in. So this is Scoot. This is how we remember the kind of the order of it. So we have our sales, what comes in. We will subtract out anytime someone returns something or that we have to give a discount on something, that sort of thing. We'll subtract those out and we'll have what they call net sales. Cost of goods sold, we just spent 3 classes doing that. And gross profit, same thing. Now, these cost of goods sold, these are the inventory sales only. And down here, these are the expenses, like, for example, rent. Oops. Okay, so this would be so this up here, this cost of goods sold, this is for um, uh, inventory costs only. So this is only for what we just kind of have been doing. This is only for, you notice that there's no, we didn't do anything with, say, wage expense or rent expense. This is only for the cost of the inventory. The operating expenses, this is where you put, this is where the rest of the big stuff goes usually. Rent expense, depreciation expense, all that kind of stuff. We come up with our operating income. Other revenues and expenses, and I already have, these are kind of the examples we usually have. These are things that are known to be incidental to the business. So this other account. And let me talk about that one. So the other revenues and expenses, these are things that are, they happen, but they're not really what we're in business for. For example, if you run a pizza parlor, you run a pizza restaurant, you're probably going to have a bank account. People come in and pay, for whatever, and then you're going to take those deposits and put them in the bank, and you have a bank account. That bank account may earn interest. Now, you're not really in the business of earning interest. It's probably not very big either. It's probably, compared to the rest of your business, it's probably fairly small. But you have this bank account and you are earning interest, but it's not really what you're in business for. You're making your money selling pizzas, not earning interest. So even though it happened, it's not really what you're in business for. It's incidental to the business. Another thing is maybe you sell, you have a delivery truck and you buy a new one, you sell the old one. Well, you're really not in the business of selling trucks. But incidental to the business is, okay, we bought a new truck, we're selling the old one. So even though selling trucks is not your business, it did happen, you sold the truck. So these are things that are not necessary to run the business, although they did happen. They're incidental to the business, and that, even though it's not what you're in business to make money doing, they did happen. You sold the truck, you got interest on your bank account and whatever. So the other revenues and expenses are for those things that are really not what you're in business for, even though they did happen. You did get interest on your bank account, but it's not, necessarily what you're in there for. So that's what these other ones are. And then lastly, of course, paying out taxes. And so taxes come at the very end. We have interest before taxes. And by the way, just so you know, a lot of times, I don't know how to say this. A lot of times for the finance area, the finance world, operating income is the most important one, even more important than net income a lot of times, because this is what they actually made on their normal business. So if their normal business is, whatever it is, selling cars, this is what they made selling cars. So if they're Ford, how much do they make selling cars? That's what would be in here. This other stuff's kind of wacky. So okay, this isn't really what they're in business for. So a lot of times this operating income, for some people, is the most important number. because it really tells, okay, the business that they're doing, you know, how successful is the actual business that they're doing? How successful is that? And that's where this operating income comes in. And that it's the normal things they sell and the things that are necessary for the business. That's all in your operating income. This other stuff is, it happened, but you know, and taxes are whatever the taxes are, whatever the tax code comes out to you. Oh, you don't really have any control over this, right? So a lot of times these, you know, right down to the operating income is where a lot of kind of finance people kind of draw the line. They say, okay, this is the most important number. How much did General Motors make selling cars? We know that there's this other stuff that went on, this stuff, the taxes, you know, those are different calculations altogether. But for just running the business, how much do they make just running the business? And so that operating income is actually a very important number. I put most important, but it's right up there. A lot of times you'll see it. You know, they'll also often talk about the operating income rather than this other stuff they really don't have too much control over. Okay, you know, I think I'm going to stop there. We'll do these problems next class, and then I think we'll do the practice exam. So the exam will be, well, after we do the practice exam next class, then we will go ahead and do the, then I'll send out the exam. So we'll stop right there. We'll finish these up. They're not too hard, those problems. But so for the next class, I'm not going to say any homework. So next class, we'll just go ahead and put in the, do the last couple of problems, the multi-step income statement, and then we'll do the practice test, and that'll be it for that chapter. Any questions? Okay, I will make I'll put it in the submit, I'll put a submit thing for the assignment for exercise 612, well, the first one we did. Do I have it up still? Yeah. So I will make so I'll make a thing for that. I'll just even submit that in. Okay. Any questions? Okay. Great thing about this chapter, no journal entries. Nice reprieve from so anyway, okay guys, well, have a good weekend, and I will talk to you guys on Tuesday. Tuesday we'll finish up the handout, and we will do the practice test.
Thank you, Professor. Have a good one.
Okay guys.
Thank you. Have a good one.
Good night. Not good night. Rest of the day.